Hey everyone, how are you? I want to welcome you to this very special episode of the HX podcast. Today, we're honored to be joined by my former colleague at Empire Financial and one of the founders and experts at Wall Street Beats, Berna Barshay. Berna, how you doing today?
I'm good. How are you?
I'm good. So how much NVIDIA stock have you traded today?
Because zero, absolutely zero.
Okay, I don't know that it's appropriate to do anything having to do with finance. I went to a Chase ATM and it basically asked me how many shares of NVIDIA I own. So it seems to be the pattern. So, Berna and I have known each other for about a decade. We met through our mutual friend, Whitney Tilson. We're going to talk about Berna's history in a second. She comes out of the consumer space. But I'm actually going to start on a funny spot. And I think this actually is a popular conversation. It's come up on my socials a bunch that people have been doing this. You recently went to France to see a Taylor Swift concert. And apparently this is quite a big thing, that there are thousands, literally thousands of Americans that are going to maybe tens of thousands that are going to Europe because the savings on the price of the Taylor Swift ticket is so great, which is funny that we're doing this on the Live Nation Day, that it actually basically kind of subsidizes the European trip. Tell me about the trip real quick. I actually really I want to hear this math.
Well, it's funny because the Arena and Ticketmaster, who handled the ticketing on this show, because it's split between them and Eventum across Europe, they put out that 20% of the seats, and there were 180,000 seats, were sold to Americans. So that's 36,000 in the primary.
Holy cow.
Just for those 4 Paris shows. But then that doesn't count all the people who bought secondary tickets on StubHub. So, wow. I mean, it could have been 60,000 people from the U.S. I think I counted people from 22 states that I met at the concert, plus 5 or 6 different countries. But, but the European countries, that's predictable, right? They're close together and people travel across them. But, there were people from California, the Midwest, the South, everywhere. Tons
Can I ask you this question, though? This is the basic math question. You don't have to answer because I'm not trying to give you your personal finances.
To answer. I'm a value investor. I went because it was cheaper.
Well, no. So how much would a ticket cost you at the Meadowlands versus how much did the ticket cost? Just the ticket. The rest of the trip.
A garbage ticket in the Meadowlands, like in the 3rd tier of a football stadium that holds 90,000 people, was looking about. It was $2,000 to $2,500 a ticket the day before the concert, which was this weekend last year, Memorial Day weekend. I do know some people who stood in the parking lot and waited till 5 minutes after the show started and got in for $1,400 or $1,500. But you're not going to do that if you have little kids. You can't leave them to the hanging like that. So buying tickets in the secondary market for the Meadowlands, assuming you didn't get into the original Ticketmaster sale, was $2,000 to $2,500. So $4,000 to $5,000 for a not good seat for 2 people. I entered the lottery in, I think, 9 or 10 European countries. I got into the lottery for 3 of them. And so I was able to purchase primary market tickets at face value, although they were VIP ones, but they were still only $600 each for very, very good seats in the first bowl.
Okay.
And so $1,200 versus $4,000, which goes a long way towards paying for your flights and your hotel and everything. And you're getting a vacation with it. So as a value investor, how can you not go for that? And then we had such a good time on Saturday night that we were sitting at lunch on Sunday, and a friend of mine was texting me who had gone on Friday and then bought secondary for Saturday. You should look at the secondary. You should sit in a different place. You should experience the same concept but from a different place. And I was able to get tickets in this secondary market on StubHub for face value plus fees, basically. So again, amazing seats, $350 each.
Wow.
Those same seats for the Miami show coming up this fall are approximately $7,000 plus fees.
Holy cow.
I was in good seats because I look up about 5 minutes before the concert started, and who's in the box behind me? But Travis Kelce with Bradley Cooper and Gigi Hadid and
wow.
her
Holy
mom
cow.
and Lenny Kravitz.
Okay.
It's It was
Well,
crazy. So it was a totally different experience. We spent the concert watching him, watching her was, it
Yeah.
was fun.
I had a concert because I've worked a lot of music. I had a concert promoter guy actually who does 200, 300 shows a year. He posted on Facebook and he's like, "Are people really doing this?" And I responded to him and I said, "I go, look, for you got to have some money. You got to have some money to go to fucking France with your kid. Like, it's just a thing." But I said it's not a crazy amount of money, but for people that were going to do a vacation anyway, it's a great, it's you might as well. It's like if you're gonna go do a week in some place, nothing crazy, no friggin' yachts or things like that, but just go out and do it. This sounds like I don't want to call it an arbitrage, but it's
It is an arbitrage.
Type of
It's like you can pay $5,000 to see a show once, in New Jersey, or you can pay $5,000 approximately to see it twice in Paris, while having 3 or 4 days in Paris. Like, to me, that's an arbitrage.
That's pretty good math. That's pretty good. So let's go through, and I'm going to say something. You and I worked with each other for a couple of years. We've talked a lot through the years. I don't know your exact background. Give us sort of a 3-minute, 5-minute background of how you got into investing. I know you've been a professional investor for 25 years now, but just kind of run us real quick through the history there.
Well, how I got into it is actually probably the most interesting part, because I was a comp lit major and a theater minor at Princeton.
Okay.
And I had no idea what I wanted to do after school. In fact, the only idea I had was I thought I wanted to be a dramaturg and go to Yale School of Drama for that. And my parents were like, why don't you go out in the real world before you get this like totally, unemployable degree? And, my dad was a professor. My mom worked in a school too. So it's not like they were anti-education, but they said, why don't you try something else before you do that? And so I decided that I was going to go get a job, any job. And I interviewed for everything. I interviewed for the consulting companies, the investment banks, the Bloomingdale's buyer program, all of it, because I really didn't know what I wanted to do. And I wasn't, shockingly, since I had no direction, I wasn't doing so well on those investment banking and consulting interviews. And towards the end of it, I had an interview with Goldman Sachs Equities, Sales and Trading. And at that point, I'm like, I'm not getting this job. My mind was on something else. And I'm like, I'm going to go in. I had done some acting in college. I'm like, I'm going to go in and act like what I think a trader is. And I was like really snarky and obnoxious. And they asked me, do you read the Wall Street Journal every day? And I said, no, but if you pay me enough, I will. Like those were the kind of answers I gave. And that was the interview I got the call back on.
Holy cow.
It's so crazy. Yeah, like those weird moments in life that determine your destiny that you just don't think about at all in the time. And then when I had my call back at Goldman, there was the guy who brought me in was the CFO of the equities division, and he was a super Renaissance guy, really into everything from art to sports, and talked to me a lot about my senior thesis, which was on the Irish playwright Samuel Beckett, who wrote in French, actually. And he asked me to send a copy of my 100-page thesis talking about the role of dialogism in the work of Samuel Beckett across his plays and novels. And the guy read the whole thing. He's like, this is an excellent thesis. It was an excellent thesis. I think I got an A or an A plus on it. He's like, well, if you can do that, like trading's easy. So, and that's how I got into it.
I got a funny story about this, because when I was at Wharton, the most coveted summer job was the DLJ summer internship. Like they took in like 4 people, 5 people, and the banking internship, and it was like the job. And, I was in a very different position than you. I was literally at Wharton and I worked at Lehman the previous summer and all that. So I get the job, I get the interview, and I'm in there and I'm in with one of the guys. And, he goes, you've got the lowest GPA of anyone that we've got in here. I had like a 3.4 or something like that. He goes, but I was the one who brought you in. He goes, I was interested, in your interest, you said Judaic studies, you said philosophy. He's like, what are you most interested in philosophy? And there were things that I was legitimately interested in. And I just went off. I just went, all down all these rabbit holes, and he loved it. And I ended up getting the job. And I got the job because I think that instead of they kind of like, I think if you're coming out of Princeton, you're coming out of Penn, or if you've got sort of the grades out of any good school or any school, they know that you can do the damn job. But are you actually interesting? Do you show some other levels to your personality? You know, there has to be some charisma, especially in equity sales and trading. Sorry, still fighting off a respiratory infection, but it was almost the same thing. I think we sat there and talked about Nietzsche for like 20 minutes, and we didn't go through it. Everyone else was getting this like, okay, well, how do you calculate EBITDA? And we didn't do any of it. And I was just like, screw it. I'm just going to talk about whatever. So I don't know, maybe if there's any young people watching this interview, watching this podcast, you should maybe keep that in mind. Okay.
Yeah,
So you get to
be fair, like, I was always really good at math, and if I hadn't been a complet major, I might have gone for like a math major. So like I had like the skill set and everything. I'd been, former mathlete, but like, I think that it's actually like what the guy saw was intellectual curiosity. And the thing that has fueled me for 20 plus years of picking stocks is intellectual curiosity, the desire to really want to understand how things work, how companies work, how consumers think, how technological change happens. Curiosity about the world around me has been, one of the core things of my success in this business. And so, whether it's, curiosity about a mid-century playwright or curiosity about, whether, Google and Meta can maintain their dominance of the internet, those are it's curiosity is the
I'm working on a book about Charlie Munger. It's actually a children's book about Charlie Munger, but the single thing that stands out probably most about Charlie Munger was curiosity. He was just interested. He was interested in a whole bunch of things, and he just spent time like trying to figure them out. Okay, so you get into the analyst program at Goldman. Walk us through all the way. Go the next 20 years in 2 minutes. Kind of what was the progression there?
So I worked at Goldman, and I worked in equity derivatives trading, which I really enjoyed. And they asked me to stay, go from analyst to associate. But I felt like I had sort of found myself in the most arcane corner of Wall Street. And I remember, I would be asked to trade Cisco options, and I'd say, do you want Cisco with a C or Cisco with an S? And it was only like 6 months into this that I realized that Cisco with a C made routers, and Cisco with an S like brought food to restaurants so they could cook it for you.
Served hamburgers.
Yeah, like I didn't know the difference, and it didn't matter because I knew the vols and the stock prices and the tickers, But I realized.
By the way, for the audience, because I'm gonna bet there are two companies named Cisco. One begins with an S, one begins with a C. One is a internet router company. The other is one of the largest food distributors in the world. Yeah. So I bet there's a lot of people that still don't know that. So
so I mean, I was that person. I didn't know any accounting. I'd taken basic economics classes for a couple of years of that, but I didn't know much. So I figured, well, to be a little bit more mindful about my career, I should go back and go to business school. And I went to Harvard Business School, and I, flirted with doing other things. I flirted with, consulting. I flirted with going and working in media and entertainment, and, pursued those things in the summer. And then decided to go back to Wall Street and ended up at Sanford Bernstein.
Awesome.
Which was, now part of Alliance Capital. They merged. When I was there, it was private, and it was really the number one institutional deep value money manager in the world at that point. And so that's where I got my buy side training, and it was a great place for training. Really good.
Can I say one quick thing? When my first buy side job was at a place called Atalanta Sosnoff, which was a money manager. I think it's still around, but founded in 1960. One of the partners there, Bill Nobler, was one of the original partners at Bernstein. Back in he was a food analyst. He actually, Cagney, the consumer analyst, he was one of the founders of Cagney.
Oh, okay.
And
I go to that conference every year.
Yeah, he literally in 1978, was I was very much steeped in the Bernstein way of analysis. From the beginning on the buy side. So it's a funny thread that goes through Wall Street, that sort of Bernstein ancestry. So
yeah, small world. Yeah. So I'm grateful for that experience. It was a great training ground. And if there's anyone, youthful listening to this podcast, I would say it is really important to choose those early jobs for the training that you're going to get in them, because they set the scene for the rest of your career. But I got kind of impatient there, doing sort of slow moving, long only, wanted to be able to short, wanted to be able to be a little quicker and more nimble in my investing, started to talk to hedge funds, and along the way got hooked up with a family office that was looking to start an internal hedge fund. So I kind of had a very untraditional route in that I went from being a long only analyst to a long short portfolio manager fairly quickly, and without, the stop in between at a big hedge fund. And I worked there for about 5 years, and kind of sort of hit a standstill on raising money and decided I would be better off working for a larger fund versus continuing to go at my own and my small fund. Because this was like the heyday of hedge funds. And I was kind of hitting that sort of like, call us when you're at 100 million so we can put 5 million in and not be more than 5%.
Escape velocity kind of.
Yeah, I had trouble with escape velocity because I was sitting in a family office and without a marketing arm, and was also really young, so I didn't have friends with money. I think had I been in that position later in my life, I would have known more people to help me get escape velocity just out of my own network.
And there's a funny thing here too. I mean, I did it a little bit. I did it 10 years earlier than you, so the world was a little bit different. It was easier. By not going to the big hedge fund, it also cost you the network that comes out of coming out of those big hedge funds, because there's definitely, because having watched it for 25 years, you come out of one of the Tiger Cubs, your ability to raise money is just different than if you're not coming out of one of the Tiger Cubs. Like it's just a fact of life. So so you've got the fund, you're not getting escape velocity.
Yep. And so I went and worked with, as one often does in this business, with a friend of mine who was growing rapidly. And he had a 300 million, I guess around 300 million. He was hitting escape velocity with a fund that he had been percolating for years. That was an event-driven fund. And I went and worked with him. I guess this was back in 2007. But we ended up parting ways pretty quickly because we had differing views on what was going to happen with the financial crisis. I was like getting very bearish on financials and such, and we had differing opinions. Then I went to Swiss Re, where I ran the consumer book, both cyclicals and discretionary, for their prop desk in New York, which was a great job until the financial crisis, and Swiss Re almost bit it. And had to be rescued by Warren Buffett.
Financial crisis was tough on Switzerland.
Yes. Yes. So left there, ended up at a large consumer long short fund that I was at for a few years, and then basically did a tour of duty through 3 or 4 different funds that were some combination of consumer, media, US, Europe over the next 10 years. And along the way, did some other stuff too. Did some consulting in sort of Series A and seed startups in both tech space, media space, consumer space. Also consulted at one very large retailer on a pricing optimization study. So got some real world experience along the way too. And that sort of brings us to 2020 when we were working together. And the last hedge fund that I was at was a European long short consumer hedge fund based out of London. I was sitting in New York, but the rest of the group was in London. And we had a great seed investor for 100 million. And, things were looking great, and then we had a bump in our performance, and it was time to go, and that fund doesn't exist anymore, and that's when, and then at that point I went through a tough personal event. My mom died pretty suddenly, and
sorry to hear that.
Right after I leave the hedge fund at the end of December, she dies January 1st of 2020. And I'm like, okay, I'm going to take 3 months off, 3-4 months off. I'm an only child. I have a lot to deal with, wrap up emotionally, financially, organizationally.
I went through the same thing 3 years earlier. It's also as an only child. There's a lot of logistics that it's hard to prepare for, or
Yes.
very few people prepare
So
for
yeah,
it.
like all the
So
things that you don't like, what do you do with somebody's clothes and all of that. You said.
passwords, like things like that. Yeah.
Exactly. So I was going through that and, here thinking, well, the year's got to get better from here. Like, this is the worst possible thing that's going to happen this year. 2020 is going to be a great year once I get past this.
Right.
Well, surprise, surprise. So, right around the beginning of March, I was like, maybe I should start looking for a job now. And then, a week later, everything shuts down. And, Whitney, I guess, had called me when he was starting Empire and said, why don't you think about doing this with me? But I had already committed to doing this startup hedge fund in Europe. And, I was a partner. My name was in the documents. Like, I was too far along that route to switch gears. But, I wished Whitney well and said, I hope this works for you. And then it's, March and everything shut down. And I'm not going to say I was bored because I was homeschooling a 7-year-old at that point.
Yeah.
But I wanted to no one knew how long that period was going to end. I just wanted to get back
The
to
world
work.
was less stimulating on a lot of other levels. Like,
Yeah,
you weren't going out and having nice dinners and Taylor Swift concerts.
Yeah,
Sure.
I needed to get back. I needed to get my head back into the markets and in the game. And I was like, well, maybe Whitney needs help. And, I had never really thought about doing anything other than working at a money manager, a hedge fund,
Yep.
insurance company, like I'd never thought about doing anything other than picking stocks and putting money in them for other people. But it was the world. It was a weird time in the world. It was a weird time, in losing my mom. It was like the type of time that makes you reevaluate everything. And I was like, oh, maybe I'll try something new. And, and that's when I went to Empire and joined you about probably, 8 months after you started. I got there. And, there we wrote research and provided, financial content for individual investors. And
Look,
it was
and
different. But I actually found love of writing when I was there because
I think that the mandate of Empire, as Whitney and I kind of saw it, was to take people who had experience like you and us that wouldn't normally be available to ordinary people that don't have hundreds of millions of dollars or run pension funds, and try to distill that in language that people could understand. That was just, because so much of the language and so much of the writing that's done on Wall Street, I feel, is put there to justify fees. It doesn't actually address the real questions that need to be answered, or why something's going to happen or what's going to happen next. It's there to sound smart, to get the fees that are getting paid, and we tried to simplify it. So obviously, as everyone knows, Empire was wound down, about a year ago, and now, and I want to come back to this in a little bit. Now you've joined Herb Greenberg, who we had on here a couple weeks ago at Wall Street Beats. Give us 1 minute about Wall Street Beats, and then what I want to do, again, you have a background, this incredible background, super deep in consumer, all things consumer, retail, media, internet. Let's jump into that and talk to us about how your approach to that, and what do you think is special about those groups? Last week we had on a guy named Jason Napadano who does biotech, which is like the most esoteric of all the places in the entire stock market. But yeah, tell us a little bit about Wall Street Beats, and then let's jump into the consumer world and tell us, what's how do you think, what are the best ways to make money in that group?
Well, Wall Street Beats is a new financial content platform, and our first product is a TV show that we do every day. So Herb was a journalist. Everybody else in this platform is an investor. I think maybe one or two people are still running funds. The rest are kind of retired, semi-retired, or consultants. I do consulting and I run my own money, basically.
Yep.
In addition to Wall Street Beat. So everybody's a really active investor who has decades of professional experience behind them. who is actively like in the market fighting, to make their dollars, with their own money, and maybe a few people with other people's money still. And, in this format, we're sharing our best ideas and in real time, and, talking about the trades we're putting on, talking about the investments that we're researching and contemplating putting on. We're breaking down, big events of the day, talking about broader macro or sector issues, whether it's, the health of the consumer, the direction of interest rates, or, is a recession coming? It's sort of the whole gamut of, very tangible ideas, but unlike what you might see like in traditional financial media, like CNBC or something, not to dump on them, but like, they give you like 1 minute. They're giving you three bullet points. Like when we go back and talk about something, we're going to introduce the idea with like 5 to 6 minutes. It's kind of like the executive pitch that you would give your portfolio manager if you were an analyst at a big fund. And then, we return to the idea, like, if something happens as the company reports and it goes up a lot or it goes down a lot, we're going to come back and talk about it the next time.
You and I both did a bunch of, a lot of idea lunches and idea dinners, and I always liked them, where you would have like 8 professionals sitting around. And while ostensibly the idea of the idea lunch was that everyone would bring an idea to the table, and often they were sector based, might be a consumer one, might be a biotech one, what have you, you'd end up just talking. And what I found so interesting about Wall Street Beats is Herb, as Herb tells that it started as it was like a WhatsApp group where there was just a couple folks that were just like going back and forth, just bullshitting about the markets. We had actually one of those about crypto and NFTs back in 21, 22, called the DGen Looney Bin, which surprisingly enough made a lot of money. But yeah, so it sounds like a good approach. So
it's great for me. I mean, I find like a lot of people are working independently now, and there's so many great things about working independently. The freedom of, my child is doing something in the afternoon and I need to take the afternoon off. I can make up all my hours working at night as a consultant and as a private investor. But, the downside of it is it's lonely, and also you don't get that intellectual sparring. And I feel like with this group, I have a virtual office now, which is amazing. And as you said, I do most of my work in consumer media and internet, but I have meaningful investments in my number one position right now is actually in healthcare. I have a very large position in an energy company. Both of them became my largest position because they did so well, not because I went in biggest at them. So, but I'm letting them ride. And so it's great to be in a group that has, former II healthcare and energy, investors in it. Cause like now I'm getting, cause it's hard to keep up on so many things, but I feel like I'm getting briefed on the most important things happening in those sectors now through my participation with this platform.
I think that just the communication on ideas it's real beneficial. I'm going to tell you, so this is a little seem off topic. I've actually found something else that has been really helpful in recent times. We have a very small team. There's 3 of us, and one of them is someone I've worked with for 35 years. He's worked with me in 5 different businesses. The other person I work with daily, and she's quite younger, but very interested in the markets. I actually have been learning so much from. She will ask questions about an idea, and she's quite smart. Understands a bit about finance, but then almost being forced to go through your thesis and explain it. Your daughter's a little young to quite be there, but then being forced to be like, okay, how do I boil this down? To someone who's smart but has no experience and is 25 years younger. It's actually helped my investing. So I think there's both sides, is like talking to people that have all this experience, but then talking to people that have legitimate interest and acumen and intelligence, but then trying to boil the idea down. It was like, holy shit, I really could just focus on these 3 things. So,
for sure. I mean, if I try to describe a consumer idea, like a retail idea or a travel idea, and if I hit like, 3 different people, say like, a millennial woman, a boomer man, and a Gen Z girl, and
Yeah.
none of the three get it, I'm probably off the scent, right? Because I should be, like an idea in retail or travel or something, it should appeal to one of those groups, because if it's not appealing to one of those groups, who's your consumer?
Well, I think it's a great point, and it goes beyond that. I think there's benefit to investing in complexity. I mean, if you're a distressed debt investor, by definition, you're investing in complexity. But to be honest, the best ideas that I've ever had, if I can't boil it down to one or two bullet points why it's going to work, I go through. I measure best ideas by two measures: where I made the most money and where I had the most stress. And the diagram intersects on the easiest things, like, we owned Nextel International. They were rolling out mobile phones through Latin America. There were no mobile phones in Latin America. There were going to be a lot of mobile phones in Latin America. They had a pole position doing it. Made a killing on the $100 million on that stock, through time. So let's do this. I want to do this. We're actually going to combine the two things that you and I talked about before. We like on this podcast, the whole idea is taking people like you. You've got this incredible experience, over 2 decades. You've got this, this great network that you have now. We've worked at all these different places. You've seen different market cycles. You've seen tons and tons of companies. And, if you were to take a non-professional practitioner, someone who's interested in investing, and they come to you at Thanksgiving dinner and say, it's your cousin says, what should I know about investing? I mean, yes, the first thing you're going to say is, we'll get a professional to help you, and like, blah, blah. But they're insistent. They're just like, I'm gonna invest and trade no matter what. I've got the broker, whatever. I'll deal with that. When you look at like where you've made money, I know you're quite eclectic in your investing. But what would be, 2, 3, 5, a half a dozen sort of core concepts that you would think in your groups, in overall investing, that you sort of guiding principles that you think would be helpful for a non-professional investor who really wants to learn to focus on?
Well, I mean, I think one thing that is key for people who are just starting out is to invest in what you know. And
Okay.
so I feel like we all have, core competencies.
Yep.
If you, love fashion, or you love travel, or you love sports, or you love technology, look for investments that intersect with your areas of passion, right? Like if you do a lot of sports betting, maybe you should be looking at the online sports betting companies and figuring out which one's going to be the winner. Or if you love fashion, then maybe you should be looking at the different retailers and apparel companies and figure out who's going to be the future winner. So, because there's two pieces, I mean, especially in sort of the sectors that I look at in sort of consumer and the intersection of consumer and technology. The reason that one thing I love about these sectors is that there's always somebody winning, even in a down economy. Because the market share shifts. Like there's certain sectors, and and people do great with them. Not me necessarily always, but like financial services, energy, materials. Like I've invested in these sectors, but these are what we called it at Sanford Bernstein. Everything was about reversion to the mean, and these sectors truly do revert to the mean. It's unlikely to see like excess earnings at a certain company for a really long period of time. Whereas within consumer and tech, things are always changing. They're not static, and there's always companies taking share. I remember in 2008 when the market was down over 30%, I had 3 stocks in my long book that were actually up, because they grew their earnings, they had prudent financial management. One of them did a giant buyback when everybody thought the world was going to end. Yeah. They Dutch tendered their shares because their business was so good. There were 3 companies that had great business. Like even, when people were losing their homes, they were just selling what people wanted. And so there's always some of that going on in consumer media and tech. So that's interesting. So the other piece of it is obviously valuation. I do think matters. Like you can't just, it's so easy.
Well, let's stick with that first one, because I'm gonna kind of and look, this is the whole Peter Lynch idea. Like in my on my Twitter profile, I've got my reading list pinned, and the first book on there is actually One Up on Wall Street.
Yeah.
And the
endorsed
reason
that
is
one, too.
I actually think the second book on there is better, which is How to Make Money in Stocks by William O'Neill. But I think if you're just entering in as an entry book, that book is so powerful because it kind of just breaks down the world it makes the investing real, as you know, like where you can understand. It's like I am a customer of this company. I work in this business. I understand what makes it work. I understand quality when I see it. So no, I think it's a powerful, and maybe someone's a doctor, maybe someone's and there's a second piece to this that I find that is subtle, is that if I give you a fantastic thesis or idea in a sector that you don't know, you very well may be like, I love that idea, I'm going to go buy it. But if something happens and it goes against you, even if it's just the damn market, you're much more likely to get shaken out. And just because you're like, I don't know, like we've got our number one idea right now is a nuclear energy, whatchamacallit, a producer called Talon Energy.
Uranium miner or something?
No. It's actually Talon Energy. It was the old PPL.
Oh, okay.
They spun out their nuke. They own the sixth largest nuke in the country, and it's a brilliant idea. I've shot a ton of video on it. You should check. Actually, Berna, if there's one thing, actually, I'm going to pay you for your time on this podcast right now. Go out and buy TLNE. It hit a new high today of 125. It's at 114 because it spiked up. It's going to 200. Anyways, you can thank me later. But my point is that if you get a great thesis, you invest in something you know, you're more likely to stick with it because you know it than some random biotech.
I have a
stock
horror story on that. Like, I had some great counsel on buying a biotech company, a particular biotech company. And I tell every biotech, dedicated investor, I always am like, oh, let me tell you my war story from this. And, I think I bought it, I can't remember the exact prices. I bought it. It went down 50%. I didn't really know what I was doing. This was in my PA, not with other people's money. And so I sold it, and it did maybe go down like another 30% or something from where I sold it. And then, a few years later, they get their FDA stuff sorted out, and it tripled from where I bought it. So I managed to turn a triple into a 50% loss because I really had no business buying a biotech stock, a pre-commercialization biotech stock. Every time I've done that, it's been a bad idea.
I want to talk about valuation in a second because we'll go to that one. But what you also said there, Herb's big idea was know thyself, like know who you are as an investor. And, in that case, and, it's funny because the last person we had on this podcast was a guy who does biotech and the one before was Herb. That's a perfect example too, where you could get the best information in the world, but you don't know the sector. It didn't fit within a comfort zone, or you didn't put it within a comfort zone. And that's not on you. That's a crazy fucking group, and that's what Herb was saying was like, know thyself, like know where you're, I wrote a lot about Jim Simons after he died a couple weeks ago. And I said, one of the simplicities of Jim Simons was he didn't actually care why the market worked or how the market worked. He only cared that it worked. And what he did over and over is figure out things that worked and did more of those, and figure out things that didn't work and did less of those. As an individual investor, that's actually something you can do, especially as you're gaining knowledge. If you have something that you're doing over and over that keeps on working, do more of it. Yep. And if you have something that you keep on sucking at, well, maybe give up and move on to something else. It's like,
and I mean, it's funny because blowing out that biotech company was, I've definitely stared in the abyss of being in the hole on so many different ideas that, have then turned out to be, absolute home runs. I think my first bite at Netflix on the crash was probably at 250, and then it went to 180, and then it became like my biggest position at 180, and I mean, I lost whatever it was, like a quarter of my money fast on that. And, and then those later purchases more than tripled in, less than 2 years, so
I'm looking at the chart of Netflix.
I really knew what I was doing in Netflix. I know that industry cold. It could have gone to 125 and I would have been buying it down even after that first initial ill-fated 250. And, the different, that's the difference. You said know yourself.
Yep.
And it's like some people also just can't take, any losses at all. I'm very comfortable with losing money before I make money, but I'm going to talk myself out of staying there if I don't really have a strong
That's
handle on the industry dynamics and the company dynamics.
the loss is one, and I'm only going to say it once because people hear me say it all the time. Plan the trade, trade the plan. If you know you can't take more than a 10% loss, then just plan accordingly, et cetera. But we've jumped to a whole bunch of other ones here. First one, invest in what you know. Second one, you said the V word. We don't really use that word around here. Not that it's a dirty word, but valuation. Talk to us about how you approach valuation, or what role that plays for you.
Well, I think valuation matters, on both extremes, right? Like, so identifying a great company is only half the battle because you have to buy it at the right price with the right expectations built in. So let's talk about great companies that are expensive. Like we've just seen big pullbacks in both Starbucks and Lululemon. And these are, Lululemon has slowed from like crazy fast, like growing 30% to growing like 11%. So that one is still growing well more than the economy and the market, it's average stock in the market, but it's growing less than it was. It just, when it was a 35 PE stock, everybody knew it was a great company. And like, something was bound to go wrong. So like, I'm just putting out there that, you identify great companies, but then you have to make sure that you're not always paying top dollar for them. If they can't, you can only do that if you have a clear view on the fact that they are going to outperform expectations. The reason that NVIDIA has been a good stock is that as expensive as it was, it keeps on beating. And the reason you said, did you trade NVIDIA? And I'm like, I have no clear view on NVIDIA beating or not beating. And given its valuation, I just can't go there. And so, I'm saying valuation matters because there are great companies that are just too expensive sometimes based on their future growth. And then on the other extreme, it's easier. Low multiples mean low expectations. If you I'm not a believer in buying cheap just because it's cheap. I don't think that was ever the greatest strategy. It probably worked better 20 or 30 years ago before there was so much indexing, when there were more active value managers than there are now. Like there would be cheapness correcting.
And there was less information available also.
And a lot less information, yes.
Yeah.
But now I don't think you can, count on a multiple re-rating unless the company surprises and is able to grow earnings faster than the market perceives. So I do think, I think about a stock like Crocs that I've been involved in for several years, where it's been both cheap and beating expectations consistently is a very sweet spot to be in.
Yeah.
So, I tend to gravitate towards one of three kinds of investments. One, I would say, is, value with a variant perception of the company is going to do better than people think, or else what I would call class of GARP, kind of investments. Like they're not cheap stocks, but you're paying a fair price for an exceptional company, which might be something like Google or Meta right now, where they're not cheap per se, but they're also not expensive for what they are and their future growth prospects. I think that, maybe Lulu's getting closer to that place soon. But anyway, those kind of companies. And then the third kind of company I like to do, which maybe is definitely not the place for a beginner to test their waters, is what I would call lottery tickets, which is stocks that are just, down 80, 90%, that are blown up and people have left them for dead. They're usually really low dollar, so big institutions can't buy them, and the streets stop covering them. And I tend to only do those really in my sweet spot of expertise, where I see a shell of a company that's been sort of left behind. Like one recently that I was involved with them was the Real, which got down to $1, and it was 20% of sales, and it had a couple of years of runway, and that's moved from like 1 to 4. Another one that I'm circling that's like that, or that I have a small position in, is Honest Company, which is
Uh-huh.
Stock that went public a few years ago. I think at 16 got over 20, got down to like $2. Very low price to sales, not going bankrupt anytime
I'm
soon.
looking at I'm looking at the charts, by the way, when I'm looking away. That's what I'm
Yeah,
actually.
that's what
That's
I
what I'm
figured you were
checking.
doing. And
Yeah,
in the
yeah,
case of
yeah.
Honest, there was a catalyst in that new CEO who I think has tremendous experience, having come from General Mills and Amazon. So really, core CP. Honest is a CPG company. It's
Yeah.
cleaner diapers, and they also
This is
do cosmetic
who
products.
was the star
It was Jessica
star
Alba, who's a
Jessica
company.
Alba. Yeah, yeah.
So clean products in baby and in personal care and in household products as well, some cleaners and stuff. And so you have somebody who is that classic General Mills experience, also ran CPG in the US for Amazon. So that's like sort of the future of CPG, the history of the legacy of CPG at General Mills, goes into this small company, first time in the CEO role, and also happens to be someone I've known for 20 years, so I'm totally biased that I believe in the CEO there. I'll do these kind of like lottery tickets, but those, like everything, in risk management is important when I go into these dicier
Yeah, yeah, yeah.
situations. They're
Very
very
small.
small positions because that by definition, these are companies where you're playing for multi-baggers. Like if things go well, you could make 3 to 5 times your money, but if
Yep.
they don't go
You could
well, you're
lose
going
you
to
could
lose
lose half of it
50 to
in a
100.
blink.
Yeah. And
Yeah,
so
yeah.
those I only do in my areas of expertise. And, I wouldn't recommend that as where you start out. Where you should
Uh,
start out is in blue chip companies or, very financially stable companies where, you understand the industry dynamics and the company dynamics, either because of
honest and
personal
real.
interest or maybe your career, like maybe doctors will do well looking into healthcare stocks and pharma
Yeah,
stocks,
yeah. Honest and real are very interesting. So you and I have a fundamental disagreement, actually, philosophically, which I don't mind bearing here, but it's actually you and I have an incredible agreement that's 10 times more powerful than our fundamental disagreement. Because you said two words. You said valuation and expectations. And what's interesting is the stocks that you mentioned, Lulu and Starbucks, have been expensive for very long times, but had been very good stocks. But they also had been beating expectations consistently. And like I pull up on Bloomberg, I pull up the EEG because I've been taking a look at Lulu. The EEG on Lulu is up and to the right. Like EEG, just so everyone knows, and my readers know it because we'll talk about it, are the analyst estimates for the earnings for that year. So, take Lulu as an example. Back in December of 21, they thought in 24 they were going to make $12.50. When we go to March of this year, they thought they were going to earn 14.35. So it actually gone from 12.50 to 14.35. In that time, by the way, the stock bottomed in 22. The stock bottomed at 275 and went as high as 500. It doubled. But then they missed the numbers, and on a very expensive stock, you miss the numbers and you're screwed. It's going to get killed. Starbucks, I was actually surprised because I had not paid that much attention. The negative earnings revision on Starbucks, that was a 16% negative earnings revision. That is massive on a company like Starbucks. So I think, and it's even interesting because I was intrigued. Honest and Real, which have been good stocks, they actually have positive revisions right now.
Well,
Like
that's
I'm
the
looking
point.
at,
Like you have to have a variant perception on these lottery tickets
yeah.
that things are going to be better. That maximum, usually when a stock's down 80, 90%, the expectations by definition are pretty low.
Well, and can I say something else? Like this is very, very key. It's not just that the expectation is low; it's that something bad happened. They missed
Oh
expectations.
yeah, bad
It's
stuff
not
happened.
just that
But
they're
in
low.
both of these
Like, yeah,
instances, there was new leadership brought in, and I've always,
yeah, yeah.
I've always gravitated. I said I worked early on that I worked at an event-driven fund. I've always gravitated towards financial restructurings, operational restructurings, change of management. Buying a transformational acquisition, a transformational divestiture.
Yeah.
These kinds of things where I find it really interesting where a company is going to look different going forward than it did looking backwards. And I feel like if that was powerful when I started like 20 years ago running money, It's going to be even more powerful now because so many more things are run by algos and by computers. And it's like you're never going to outthink the AI machine that is like running correlations and algos and trying to predict the future from the past. So as an active investor in single stocks and single stories, I have to identify the situations that are so idiosyncratic that like a computer would never appreciate them. I'm gonna tell you a story because it does get to another one of these principles I have. One of my other principles is that ideas can come from anywhere. And so I had a long history of like, for example, like especially like in like the apparel area, doing really well in apparel and footwear based on like watching street trends in New York, primarily LA, secondarily, because usually things start on the coast and then they move in. Not always, but a lot of the time, right? So I remember like 20 years ago, everyone was wearing Puma Nostro sneakers and buying Puma and getting like a triple out of Puma when that sleepy German footwear company, came back out of nowhere.
Crocs, by the way, are from Broomfield, Colorado. I just want to say
yes,
that.
Yes, I know they're from Colorado. Yes, and Crocs would be a trend that probably moved out from the center of the country to the edges.
Yeah.
Sorry,
I just want to tease you on that one.
But like there've been, like Kate Spade was another one where I had like a very good run with that stock. Noticing, popularity and like growing distribution and things like that. So you can notice things anywhere. So a good example that I always like to tell is I had owned Lionsgate probably around 20 years ago when they merged with Artisan and originally became a powerhouse in horror and gotten like a triple or something out of that stock going from, or maybe quadruple, like 2 to 8 or something. I owned it, And then years later, I had just watched that movie Winter's Bone, which was Jennifer Lawrence's first movie. And I just was like astounded. She was nominated for Academy Award for that performance, and I was astounded by this young actress. I thought she was phenomenal. And around the same time, my stepkids were teenagers, and I noticed a lot of the kids were reading The Hunger Games. So like I picked up the first book of The Hunger Games, and I read the book, and I am a notoriously slow fiction reader, especially for someone who was a comp lit major. I just read so much during the week. I don't want to read on the weekends. I took that book and I was done with it in a weekend, which is pretty much unprecedented. It was such a page turner. It was totally captivating. Then I'm like reading Entertainment Weekly, rest in peace, victim of the new media age. But I was a subscriber for 20 years, and my
it was fun.
What's that? You were too.
It was fun.
I can't remember if it was my boyfriend or my husband at the time. I think we were already married. But anyway, I was reading Entertainment Weekly, something that my husband would make fun of me for because he was reading the London Review of Books or whatever and being snobby towards me.
I liked Entertainment Weekly. I don't know what to say.
I read this little blurb about how Jennifer Lawrence had been cast in The Hunger Games.
Okay.
And I was like, whoa, that's like perfect casting. Like, and here's where like the theater minor and comp degree all of a sudden comes to play in my investing. And I'm like, that is the most brilliant casting. She's going to crush it. It is going to be so good. And then I start researching and I read that like every big studio had turned down that property. And, I knew the Lionsgate guys back from when I had invested in it, in 2003 or whatever. And I'd known them for years. And I was like, this was brilliant. Like they realized a property that everyone had ignored, similarly to everyone saying no to Tyler Perry for years when he was like selling out theaters around the country and they did a deal with him. Like they found a spot that like a blind spot. Nobody thought people wanted a female action hero star. They thought it was too violent, like whatever it was. The studios all said no. And I had, the sixth sense that this was going to be a huge movie, like really early. Then I did the analyst stuff. I modeled it out and I said, like, what could the revenues be? What's the rev share with this movie theaters? What are the different windows going to make? It's not like it was just an idea. There was math and spreadsheets.
At the time, the Lionsgate balance sheet was pretty decent at that time.
And so I looked at what the delta could be, and there's the variant perception. It's like if this movie does 200 million, like forget about having 4 movies that do 300 million, and there goes the stock. And you know what? A computer is never going to be able to put that together. I mean, maybe, I don't know, but there's too much qualitative, and that's what I like love about consumer and media and internet is like, I remember like very early in my career, I would like walk around, and I mean, this is like probably going to get me in trouble saying it. Like, I would see there was like two kinds of people, like going to like the Nike meeting or the VF meeting or the, whatever, the Philipson using a PVH meeting. It was like, there were like people who really liked fashion, who were like investing because like love of product and
Right.
but they weren't really good at math and numbers. And then there were people who were like really good at math and numbers, who had all gone to like Wharton undergrad or somewhere similarly excellent in teaching you how to like model and know their CFAs and everything. But like, they could be sold any bill of goods on like what the consumer was going to want, because they didn't have any like real world street smarts around, the qualitative. So like, I love these sectors where you have to put like the qualitative and the quantitative together, because, there's a special sauce to it, like you have to have both. And, that's sort of like, you have to be able to recognize the brilliance of putting Jennifer Lawrence in this book, that you have to be able to read and understand how good it is. But then you also have to be able to do the spreadsheet and make sure that the numbers work out, that it's not all priced in already, that the math.
I think you've got a great insight here. That is, and let's get back to AI. AI will never be able to, or quant models can't make judgment calls about what will actually appeal to human beings. And that's a fundamental thing, so we recommended, actually the recommendation, they're blowing me up today. Recommendation was supposed to go out today, and they're like, they want to get it out tomorrow now. There's a whole thing. Should we put it out at 8 a.m. tomorrow since it's a holiday weekend? I didn't even know it was a holiday weekend. But, we're recommending a company that the fundamental value proposition, once you understand the company, is just like, like amazing. Like I if you go through, it's something you do all the time, every day, and you hate it. And they're doing it in countries where people hate it 100 times more than you hate it here. And they figured out how to do it, because it wasn't that hard to just do it and make it really easy, so much so that you kind of actually enjoy doing it. And like a computer, you go through that experience of doing that, going through that process personally. A computer will never figure out, oh, humans hate this, but now this new version they don't hate. I think that's a very, very interesting insight. Okay, so I'm gonna summarize back to we'll kind of go to three things here. Number one, invest in things you know. Number two, we're going to say valuation and expectations, but I think it's as much expectations and variant perception as valuation. Valuation can be a magnification of the importance of expectations. Obviously, if valuation's very high, very small misses in expectations can have very large negative consequences, and vice versa. But number three, and I think this might be the most interesting thing by far, not that everything hasn't been very interesting, the Taylor Swift stuff, I got the $5,000 number, it kind of blows my mind. This idea that, it is, we are, as human beings, able to identify fundamental propositions in companies that machines will never understand. Like, we don't give away free ideas, but I wish I could talk about the idea that we're recommending tomorrow, because if you went through it and just were like, wait, this is what was happening, and now this is what is happening, it's like the most obvious thing on earth why this company, and the company's gone in 10 years from 0 customers to 100 million customers. I think it goes to 500 million in the next 10 years. But a machine will never understand that. It could never do that equation. So I think there's something, I don't know if that's to say common sense, common experience. I'm going to have to
intuition. Maybe there's some.
Well, it's not intuition, because a lot of what you're saying, some of it's intuition, like you were putting together the Jennifer Lawrence stuff, but some of it's just plain human logic, that a human can understand something about human experience that a machine can never really understand. Like, they can maybe create algorithm that kind of takes pieces of these are the things that seem to constantly appeal to humanity. But I mean, even things like I just go to what's it sound like Google search, just the core idea that I have a question, and this is part of AI, and can I go someplace where I can answer almost any question in like seconds? Like, a machine's never going to tell me that's a great idea. That's just a great idea, and you need a human being to figure it out. Your Jennifer Lawrence is the deep cut, deep down in the weeds of it. Okay, so we only have a little bit more time. Let's do this. Where can we find you? I know you're on Twitter. You're kind of active on there. Wall Street Beats. Give us all the URLs, all the places to find you. Check out. You have done some stuff on Substack. I'm sure you probably want to be. What's the plan? How can people access the wisdom of Berna Barshay?
Well, you can find me on Twitter, Hedge Fund Girl,
Okay.
and that is my Substack as well. I haven't been as active lately because we've been working on gearing up the Wall Street Beats, and
Yep.
and then obviously you can find me at Wall Street Beats, and there's also the Wall Street Beats Twitter as well.
Okay. Very cool. Well, great,
Berna.
And
I'm on LinkedIn, and I guess those are the main places to find me.
Okay, great. No, and I'll say this. I can't wait for you to start writing again. The pieces you did for Empire just were amazing. Like you did these deep dives. I was like, what the hell is she doing? This is like a 3,000 word like deep dive. We're giving it away for free. I thought you were kind of crazy, like not in a bad way. I almost felt bad. I'm like, oh my God, I can't. This is so much work. They were spectacular.
I do like writing. So I have a lot up on my Substack, which is, I should have mentioned, it's Consumer Culture Commerce.
Okay.
It's Berna Barshay, Hedge Fund Girl. Consumer Culture Commerce. There's a lot of what's on there is evergreen, and I should be back writing again there shortly.
And I want to. I'll say this to folks.
Wall Street Beats launch.
I'll say this to folks. Once Berna comes back and she's writing again, absolutely subscribe. The intensity, the knowledge, the comprehensiveness of these pieces, they were amazing. They were absolutely amazing. And I know recently on Substack, I think you've written like one a month, and they're like, I feel like they're 120 pages of excellence, again. Like, I feel like it must be like, you don't want to see your husband for 3 days. So you're like, okay, I got to go write the 100 page Substack or something like that. But it's
thank
it's
you
fantastic.
for the endorsement. I appreciate that.
Yeah. And nothing against your husband with that comment. So again, I want to thank Berna. It's always been a pleasure. It's always been a delight. Loved working with you through the years. Look forward to doing a lot more. Please follow her, Hedge Fund Girl, Wall Street Beats. Follow her on Substack. And I want to thank everyone here on the HX podcast for following us and supporting us. Tell a friend. You know where to find me, HX Research, and everyone have a great week.